Welcome to Kitco News. I'm Niels Christensen. The gold market just can't seem to catch a break as we've seen prices drop below critical support levels. The price has seen consistent selling pressure since hitting a 5.5-year high last week. Here to talk about his views on the price action is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Thank you very much for joining us today, Michael.
Hello, Nils. Good to see you again, and thanks for having me on.
It's great to have you on. So what do you think? What's your take on the price action? On the specifically the pullback that we've seen, do we need to be worried that the prices are struggling to hold support at 1,700?
Not at all. It's noise within a trend, and as a former day trader and reformed day trader, you're not supposed to care about little moves like this, certainly for those of us who look at it as a position. And so I'll dispute a little bit what you said at the beginning. It's fallen through key support. I look at gold at 1,700 and just building a base. It could get to 1,600. I doubt it. I think it's the next real big step for gold is getting above 1,900. Questions time. I don't think see what's going to take it to not go higher. And I can think of a dozen reasons for it to go higher. But just a few days ago, it was 34, almost 35% above its 52-week average. It's just a bull market that's pulling back a little bit. Same as like crude oil got way too cheap. It's bounced. The stock market got too cheap. It's bounced. I look at it as a long-term trend. It's just consolidating for the next move.
You've described this in your reports as a stair-step rally. So I mean, is that what we should be expecting? Is like 2 steps forward, 1 step back, building these consolidation, these support points?
Yeah, well, it's such a mature big market compared to things like Bitcoin that doesn't have the depth. And I've been describing it as a stair-step rally for too long. I don't want to recover how long I've been saying it because the key issue was last year getting above 1,400. And that was last year. Remember, it's probably a little bit, actually, I think it was July. So it's less than a year. And here we're talking about 1,700. Well, it sounds like a bear market to me. So anything in between is just try not to get caught up in the trees. The forest is gold prices are going higher in dollar terms. And if you look at on a year-to-date basis, I mean, gold's up, 12, 13%. Trade-weighted broad dollars up 7%. That's quite significant. And the only other commodity on the planet that's up for the year is palladium. I mean, there you go. It's a precious metal. Wow. What's close? Silver. So to me, it's just a matter of time. Unless you expect a massive recovery in the stock market tomorrow and Fed easing, Fed tightening right away, gold's on a trajectory and it's higher.
Well, okay. Well, let's look at equities for a second. I mean, we have seen new momentum in equities recently. It seems like every time we get sort of some vaccine news, hope just sort of drives this market higher. Is the price levels in equities, do you think, sustainable? And is it positive or negative for gold?
I don't think equity prices are sustainable about these levels. And that is the biggest debate on the planet, I think, right now, and it should be. I think the market's at high risk of being in a delusional period of thinking liquidity is going to pump it up. And I want to ask myself and you and our audience, who did not expect a massive amount of central bank liquidity in this environment? To me, it was just completely predictable. So using that excuse doesn't work. The lack of earnings, the greatest global depression since the Great Depression, is probably going to happen. Equity market, I view as delusional at these levels. And it could go higher, and it could. I've been wrong on that for a while. But if and when it turns back down, which I think might be happening now, we're May 27th, with the S&P, just not having much room above 3,000. That is the catalyst for stocks to go for gold to go higher, because equities failing here means more Federal Reserve easing, the potential for negative rates, more quantitative easing. They'll just keep trying to push it higher. And my key point is this: the gold market has been outperforming equities for quite a while, certainly since the beginning of the new millennium, certainly since the first tightening in 2015, and definitely this year. So I look at it as, when you look at the old mantra, in terms of equities, don't fight the Fed. To me, that's getting past the point of positive returns, diminishing returns for equities, and more positive returns for gold. So to me, when a rock beats stocks, which gold has been doing, stick with the rock.
Yeah. Well, it's hard to be optimistic on the global economy, or in the U.S. economy, when 30 million people are unemployed. I mean, even if 80% of that, even if 90% of that employment comes back, you're still seeing job losses in the millions. Like that's not a healthy environment for earnings.
Yeah, definitely not health environment for earnings. It's the whole premise. People, I think, are missing human nature. And that, in terms of human nature, is when this type of event happens, historically, people shift their spending habits, their mentality for generations. So I don't think we're going to come back to the old days of spend what you can and earn right away. We're going back to save, conservatism, more saving, and always prepare for the worst, which means more demand for things like gold and bonds, and there's no more yield in bonds.
I know, not to look at the trees for the forest, but what are your thoughts? How do you play the gold market now? I mean, we are entering a seasonal slow period for gold. Should you be looking to buy on dips? Should we be looking to wait for that $1,800 breakout? How do you play gold in this environment?
On dips. That simple. And I have to stick with that opinion. Been saying it for a few years. I don't see at some point, as we mentioned last time, gold should get stupid expensive. It should. It's just like crude oil got cheap and like the stock market got too expensive a few months ago. It should get there. It's made new highs in virtually every currency on the planet. Just a matter of time for the dollar. And to me, this is just the beginning of a new bull market. And it should not get exciting until we take out 1900. And I didn't say it. Questions time, and I'm not going to go there so much. Probably is going to happen this year. If the stock market rolls back over, it should happen this year. So you're supposed to, I think, accumulate gold on dips, potentially continue to do what people have been doing for a while. Any type of gains in the stock market should be, I think, allocated somewhat into gold, and stick with the winner. The rock is beating stocks. That means something, and it looks like it's gaining endurance.
You've given me my headline. So this is a fantastic conversation. One last question, just because we are seeing a bit of a pullback. Wanted to ask, what level do you start getting worried at? You did say at the beginning, gold prices could fall to 1,600. Where do you start to sweat when it comes to a pullback in this market?
Well, as a strategist, I love to define the difference between could and should. Hi, honey, I should be home by 7, but I could get picked up, abducted by aliens, and come back for the birth of our firstborn. So to me, gold can do anything. It should go higher. It's much likely to go higher. All the indications I have, the gold price should continue to appreciate. A dip, maybe if we get another little flush like we did in March, which was a good little sign of buyers below the market, sure, that could happen. But I suspect that's sometimes what happens when you get people too overweight long in a leveraged way, which I don't suggest. Just look to buy dips and accumulate. And the more time we spend like this, it builds that base for higher. So that to me is where I like to say it really should go higher. I'm not fading from that, and I don't see what it's going to take to really sustain lower prices and except in a world that's just gone back to wonderfulness. And right now I see nothing but continued deflation. And at some point, which is not even there yet, pretty good amount of inflation, which technically almost always is currency debasement. And that's a long way off.
So, and I know I said that was my last question, but I lied. Before you go, your thoughts on silver. We've seen silver really catch up, outperform gold. We've seen the gold-silver ratio drop below 100. Does silver have more to go? Should we be concerned if we enter a new phase of pessimism? Will that weigh on silver?
Yeah, stocks going down, the stock market failing in the global economy in a great depression is bad for silver. Two key things you need for silver to outperform gold: a weaker U.S. dollar, which is not happening, and bond yields to be going up, which is not happening and unlikely to be happening for a long time. Historically, that's what you need. So I look at the gold to silver ratio; it's still trending higher. It reached a pretty good high. I think it was around 120 or so. 52-week moving average still trending higher. Getting back into dips into that trend, you're supposed to still focus on gold. And I think silver is going to appreciate only in the back of gold. And I hate to say, but that's the facts. It almost always doesn't outperform unless you have this global demand pull. I mean, remember, it's much more like copper now. It's an industrial commodity. and the dollar has to be declining and interest rates have to be going up, i.e. in a global expansionary environment. And that's probably unsustainable. This V bottom that people are looking for in the market is very unlikely.
Mike, as always, it's such a pleasure to talk with you. I really enjoy your point of view. Thank you very much for joining us today.
Niels, thanks for having me.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.